Welcome back to the channel, guys. I'm your host Buckning, and today we're going to give you a update, talk about the market. But what we're definitely going to talk about is a question that has come up that was submitted by Charles. Charles has been a great supporter of the channel and always submits questions in the comment section below, and so we will answer his question about what happens when you go over your contribution limit, let's say in a tax-free savings account. And I'll explain some scenarios in which that might happen and really how to understand the limits. So we'll just go ahead and get started. But if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And so, yeah, we'll just get right into it. So starting the day off today, we're up $30.29, up 2.16%, which is fantastic. We are on a great run these past few days here, past couple days, sorry. For the week, we are up $81.05, up 6% in the week. For the month, we are up $185.42, up 14.88%. And for the 3 months, we are up $211.64, up 17.35%, and the same for all. So we are just going up, and it's just fantastic. And so we did purchase a Loblaw share last week, and we will be purchasing another batch this coming Friday. We did invest $100 this week, which is actually today, and I'll show that right here, and just for proof as always. And so just give you a breakdown, we have 5 shares of BMO, which closed out at today at $97.28. We are up total return of $79.80. That's up 19.63%. Today we are up $12.20. We own 5 shares of Bank of Montreal. The next share that we own is Bank of Nova Scotia. Closed out at $64.45, up 58 cents. We are total return of $69.10, up 18.09%. Today's return is $4.06. We own 7 shares of Bank of Nova Scotia, and it is 32% of the portfolio. Manulife Financial Corporation, we're closed out at $22.58, up 87 cents per share, up 4.01%. We're up $56.42, up 17.23%. Today's return was $14.79, up 4.01%. Our newest position closed out at $64.09, down 76 cents, down 1.17%. We own 1 share. We are down today of 76 cents, but our total return is 2 cents at 0.03%, and it holds 4.63% of the portfolio currently. And we have $46, so we did deposit $100 today, which will be in there by Friday. And yeah, it's a good day. It's a good time to be in the market. These past couple days have just been crazy. Yesterday was absolutely amazing. Stocks were just up. It was crazy. And for all you value investors, I know some of you might be Tesla owners in the shares, and congratulations on that. I have a few other positions in companies that don't pay dividends, but have just been doing very, very well, which is absolutely fantastic. I have doubled in some of the positions. Just to give you an update on that. I'm not going to show you the portfolio, but we're just in a good position. And so we don't know how long this run's going to go for, but it's good to have that, compared to these past few months where it's just up and down. But it's a great time. Great time for the marketplace, and just great time overall. So congratulations to all of you who hold positions in maybe growth stocks, because there has just been a rally going on in the marketplace. And so the question that comes from Charles is right here. I don't have the question in front of me, but that is okay. Charles is asking, what happens when you reach a contribution of $69,500 currently? And that is based off his age. Not based if you just freshly turned 18 today or yesterday or this year. You were only allowed a certain contribution room this year if you just turned 18. You don't get the past contribution room, unfortunately, and sorry about that. So what do you do when you're at the max contribution level? So the way that it works is, let's say you did have some shares in there. Let's say you had $10,000 in there, and that $10,000 is already in a tax-free savings account, and that $10,000 turns into $70,000 from dividends, from capital appreciation over the years, and now you're technically over the limit of 69,500. You do not get taxed on that. Any growth that happens within the shelter of the tax-free savings account is non-taxable. So let's say your investment turns into $100,000. Even though your contribution room is $69,500, you don't have to pull it out because it grew within the account. Anything that grows within the account, whether it's from dividends, whether it's from capital appreciation, from you selling a position in massive growth, is non-taxable. It doesn't get taxed. The only time that you have to take money out is if you get a notice from our Canadian, the CRA, Revenue Agency, Canadian Revenue Agency. They'll send you a letter and let you know that you have to pull some money out. And that is only if, let's say you're at 60, let's say you contributed $69,500 into the portfolio total, and you put in another $500 from the outside. So from like a checking account, you put it in there. Now you've contributed $70,000. You as a person have contributed $70,000, and that is when they will send you this notice and say, hey, you can't put that money in there. You've already contributed as much as you can total. And so hopefully that makes sense. So anything that grows within the account is non-taxable. Anything you put in there is taxable. That's why they have, if you go, for Canadians only, if you go to your Canadian Revenue Agency website, create a login and sign in, they will actually tell you your contribution room, and that's how much you're allowed to put in. So let's say you had $30,000 in a tax-free savings account and it grew to $69,500, or yeah, you had $30,000 and it turned into $100,000. You still have contribution room of $39,500 because you only put in $30,000, even though your investment now is worth $100,000. Does that make sense? Hopefully it does, because it's definitely confusing. There's definitely some rules that apply, but there are some people, if you want to Google it, that have over $1 million in their tax-free savings account. You're like, how the heck did they do that? Well, they did that from capital appreciation. They took a big bet on a company, or they did a lot of trading where it was like a lot of swing trading. Like, I bought it at this, I sold it at this, I bought it at this, sold it at this, bought it at this, sold it at this, etc. And they just got up to that point. But there are people that have over $1 million in the tax-free savings account. But again, I'm not a financial advisor. I'm definitely not your financial advisor. So I definitely go seek professional advice. This is all my opinion. I'm just sharing with you what I have come to learn. But always fact check me, obviously, because I'm just on YouTube. And so hopefully that does make sense. So if you've put in $30,000 and it got to $100,000, you still have contribution room of $39,500 to put in, because you did not put in that other $70,000 in there. That $70,000 grew within the account. It's like another example is let's say you have a home, and your home multiplies by 5. Let's say 5 more people grew up in this house, they were born in this house, and you're only allowed 7 people in the house, and you try to bring in 3 more people. That's not allowed. It's not allowed. Weird analogy, but hopefully that makes sense. I don't know if it does. But yeah, so anything that grows within the account is safe, not taxable. You don't have to take it out. Anything extra that you put in over your contribution room maybe might get taxed, is what I'm trying to say. And you always get a notice from the CRA about that, and then you just have to withdraw it. But I don't think you'll have that problem. But once you put in $69,500, you can't put any more in into a tax-free savings account. But any growth that happens from your $69,500, you don't have to take out, because that would be weird. That'd be super weird. Then you'd be forced to take out your gains, forced to take out your dividends, and that's just like a savings account to me. So, but this is an investment account. In my opinion, that's what it's meant to be used for. People that use it for a savings account, I don't see the purpose in that, because you get like 0.25% or like a bonus percent of 1. 2, which is really not that good. As you can see, we're up 17.35% in a tax-free dividend portfolio that we build off Wealthsimple, and that is more than inflation. We're killing it. We are killing it off our $1,400. Like you can see, like, I don't know if you can see it on the graph here, but you can see on the net deposits, it's only $1,220. We're up over $200, which is fantastic, and that's just from choosing stocks and maybe some dividends. So hopefully that does make sense. Thank you for the question, Charles, and thank you for your continued support, brother. I know you watch a lot of these videos and you submit a lot of questions, and I love that you keep on wanting to learn and make sure that you're getting all the facts and the details, and I appreciate that so much. And thank you to everyone. We are at 126 subscribers. You guys are helping the channel grow a ton, and so thank you. So if you guys did enjoy the video, hit a like. If you haven't subscribed, subscribe. It really helps the channel out. It really helps our community grow. And leave a comment, because I do answer the questions. I do read the comments. I do answer the questions, and I appreciate you all. So we will see you guys on Friday, and hope you guys have a great week. Keep your eyes on the market, because I believe it'll keep on going for at least another 2 weeks, maybe. So yeah, that's pretty much it. We'll see you guys in the next one. Bye.